On today's episode, we're going to check out the latest and greatest on mortgage rates, understand a little bit of why they are the way they are and what things could be looking like for the next couple weeks. Then I have a very important mortgage update surrounding appraisals. And then for our Did You Know segment, we are going to wrap up our 3-week, 3-part series on home equity mortgages and HELOCs by doing a comparative analysis of both side by side. Let's get into it. Welcome to Mortgage Markets and More. I am your host, Peter D'Angelo. I hope you're all having an amazing week as we're struggling through the cold here in North Jersey. I am excited for today's episode because we have a lot of very good information to share and some exciting updates that I talked about briefly a few weeks ago, but now I have some more detailed information to share. So we're just going to get right into it, starting off with our review of mortgage rates as per Mortgage News Daily survey as of today, when I'm recording this podcast, the Thursday morning before its release. Starting off with our 30-year fixed rate mortgage, we are averaging currently 7.02%. The 15-year fixed rate mortgage is averaging 6.44%. The 30-year jumbo mortgage is averaging 7.35%. The 30-year FHA mortgage is averaging 6.39%. And the 7/6 SOFR adjustable rate mortgage is averaging 6.94%. Overall, quite a bit less. As a matter of fact, the movement on the interest rates happened on the day of the release of last week's episode. So that market volatility that surrounded the consumer price index report from last week, that got absorbed, digested, and Friday we saw interest rates actually improve after the knee-jerk reaction of rates going up. So that's good news. This week, they've been creeping up a little bit, so that's why we're not seeing that much of a decline on interest rates compared to where they were actually on Friday last week. And we'll see. Let's take a look at the bond market. What's that telling us about where things are and where they're going? The 10-year Treasury yield is at 4.529%. The 5-year Treasury yield is at 4.356%. And the 2-year Treasury yield is at 4.264%. Overall, that's all suppressed and down a little bit from last week. So that created this environment of some lower interest rates. Well, what were the things that happened that made the rates do what they did? Well, we're going to start off with the Producer Price Index. Simply said, the Producer Price Index is an indication of what it costs the manufacturers and the producers to obtain the goods, services that then get provided to the consumer. So you can kind of think of it this way. CPI report shows you what the consumer's paying for things and what the increase in cost is there. The Producer Price Index shows you the increase in cost for the things that are sold eventually to the consumer. So that came in month over month with price appreciation of 0.4%. That compared to the estimate of 0.3% and prior reading was 0.5%. The core month over month, excluding the volatile elements like food and energy, that came in at 0.3% price appreciation. That's compared to the estimate of 0.2% and the prior reading of 0.4% appreciation. The year over year number came in at 3.5%, and that is unchanged from the prior reading from the prior month. The core year over year, excluding the volatile elements, came in at slightly less, 3.4%, and the prior reading was 3.5%. So a little bit of improvement there. That kind of shows us that wholesale inflation still remains elevated, but some of those data points are showing a little bit of easing, even though it's not much. A little bit of easing on the core was good to see because the core is something that I think gets paid a little bit more particular attention right now because of the increased volatility across everything these days. We also received the January retail sales data, and that came in much less than expected. So retail sales came in at negative 0.9% month over month, and that's compared to an estimate that was supposedly expected to see 0.2% growth in sales, and the prior reading was 0.7% growth in sales. So a little bit of a softening there. We also saw the Federal Open Market Committee meeting minutes. Those were released this week. And what that showed us was nothing really new. The Fed maintained their policy rate at 4.25% to 4.5%. The economic outlook takes into consideration the inflationary pressures that persist, and the job market is showing resiliency and stability. Unemployment went down a little bit. So the Fed does not see a reason to change their policy rate. Fed Chair Jerome Powell, as I mentioned last week, mentioned that he believes that the policy is currently restrictive enough. So they're keeping it as is. We'll see how things develop. The one item I wanted to highlight was that the Federal Reserve in their meeting minutes discussed their balance sheet. So we keep talking about the interest rate. That's the Fed fund rate. But the Federal Reserve has a balance sheet of their own, and the Federal Reserve actually purchases the debt of the United States government. And the debt of the United States government, for the smart kids in class, bonds. So the Fed is a top buyer of bonds. When they're a buyer in the marketplace, they are creating the competition. For bonds, when prices go up, yields go down. There was a little bit of commentary in there that they're holding off on what they call a balance sheet runoff, which is when they start pulling back from being a buyer in that market. What that means for people is that there's still buyer demand that gets to remain baked into the bond market. And that's part of the reason why we see these bond yields stabilizing in this range for right now. The other thing to consider and highlight is the fact that the 2-year and the 5-year Treasury yields have now further flattened out on the curve, and we're seeing a more healthy and natural 2-year yield lower than a 5-year yield, lower than a 10-year yield. That's the flattening of the yield curve. That also means we talk about the 7.6 SOFR adjustable interest rate. Something that I've noticed over the past couple weeks is that there's also a 5.6 SOFR adjustable rate mortgage. There's a 5.1 ARM adjustable rate mortgage. Those have been showing some serious discounts to clients. So keep in mind about adjustable rate mortgages. Don't sleep on them. Next week, we're going to do a deep dive. That's going to be our Did You Know segment. We're going to talk about adjustable rate mortgages, and particularly because they're actually becoming more effective for an affordability standpoint. So we're going to talk about that next week. Moving on to our mortgage update today, we're going to discuss, and again, I apologize in advance, we're going into acronym city, everybody. Grab your passports. We're going in. So there's going to be a couple acronyms here, but we're going to talk about appraisals, particularly appraisal waivers. We discussed this a few weeks ago, but we're going to deep dive into this because there was a recent release from Freddie Mac. So when I say Freddie Mac, we're talking about conventional loan financing exclusively for this. And the release was detailed information surrounding the eligibility and possibility of appraisal waivers. For a quick refresher, appraisal waivers are something that could be available that is based upon the guidelines that we're going to talk about now. But when it comes to you as a prospective home buyer, or for real estate agents out there, your clients, it will also take into consideration their credit profile, down payment amount, debt to income ratio. And that will be loaded in to our automated underwriting system. And when we use Freddie Mac's automated underwriting system, it will give us a response when we plug in the property address and how much the client is under contract to purchase for. This system may say to us, you are appraisal waiver eligible. You do not need to have an appraisal report ordered for this, which has tons of benefits that we're going to get into. So we're going to talk about the acronyms now. We're going to establish ACE, Automated Collateral Evaluation. Automated collateral evaluation essentially means that Freddie Mac has all of this data from appraisal reports performed going back, I'm pretty sure it's close to 15, 16 years. So with all the data that's been uploaded, which is part of the mortgage process that gets uploaded into their system, well, the system is now able to extrapolate market data, market trends. So when we plug in a purchase price, the system is able to understand if that purchase price is within reasonable range for that market, for that location, based upon current trends and home price appreciation and current values. This also helps tremendously because there's no representations or warranties required from the lender regarding the property value or condition. It's an automated system that already gives us the thumbs up and the approval for it. The update that we're sharing today surrounding the automated collateral evaluation is that this is now going to be eligible for purchase transactions on primary residences with a maximum loan-to-value ratio of 90%. Translating that to down payment, that means if you're putting 10% down or more, you could be in the realm, you could be in the ballpark here to get an appraisal waiver. For no cash out refinances, let's say you got a mortgage 2 years ago, and even with rates being at averaging 7%, it makes sense for you to refinance because maybe you're looking at an interest rate closer to 8%. If you refinance right now and you're just paying off your current mortgage, there's no cash out being taken out of the property, LTV up to 90% could be appraisal waiver eligible. Because you purchased that property and likely had an appraisal done, you have a high likelihood of obtaining that appraisal waiver. Thirdly, cash out limits. Yeah, this is going to apply for cash out transactions as well. The cash out limits for primary residences is 70%. And for second homes, so these are vacation homes, it's 60%. So that means you need to have 30% equity on a primary residence or 40% equity on a second home. So it's a little bit more aggressive there, but still, if you're in that range, this could be extremely helpful. Now for the second acronym, PDR, Property Data Report. This is not an appraisal. A property data report is an on-site collection of property information. Essentially, someone goes out to view the property and exclusively looks at it for the condition of that property. That's it. There's not an appraisal. There's no comparable sales included in this report. It is something that purely verifies and can be uploaded into Freddie Mac's system to let them know property's in good shape. There's nothing that is a red flag or anything that needs repairs or anything that triggers the need for a full appraisal. Now we're going to put these two together. The ACE and the PDR being put together, it creates more flexibility for underwriting. The underwriting process is the approval process of the mortgage. And this is available for cash out and rate and term transactions and purchase transactions. Pretty much we're going to be sticking to primary residences and second homes. Investment properties still going to require an appraisal, particularly because a part of that appraisal process is doing a comparable sales analysis in addition to a rental income analysis. And that's a very important part of the underwriting process to understand what market rent looks like and how that translates into value for that property. The benefit for this, like I mentioned, is the fact that you will not need an appraisal. That, number one, saves you money. Appraisals cost money because we need to pay an appraiser for the report and for the services of the inspection. Secondly, speed. Oh my goodness. Without needing an appraisal, you can get a loan, especially here through rate. We get our loans into same-day mortgage. You can have a full-blown commitment on your mortgage within 24 hours because we already have an appraisal waiver. If we have a full loan file, I was a beneficiary of this. One of my clients got cleared to close in 5 days because they had an appraisal waiver and they gave me all of the information and documentation required for their loan. They were good to go. One of my other clients still needed an appraisal. That only took 7 days, and we were cleared to close a whole month before the closing date. So there's a lot of power in these appraisal waivers. For looking back right now, let's think back. I mentioned last year in 2024, the average down payment amount for first-time homebuyers in the U.S. was 9.8%. I mentioned this last time I brought this up, but I want to drive this point home. If first-time homebuyers are averaging 10% down payment and our appraisal waivers now are eligible up to 90% loan to value, aka 10% down, it's reasonable to assume this could provide a lot of benefit to first-time homebuyers, help them to become more sharp and competitive, because if I have an appraisal waiver for my client, because of these new updates, if I have an appraisal waiver for my client, I get to share that information with their agent. Their agent can then structure their offer to communicate to the seller, we have great buyers here, they're mortgage approved already, and we are waiving the appraisal with an appraisal waiver already eligible. That lets the sellers know there's not going to be any appraisal required, so there's no renegotiation on that contract price, and it gives the sellers a lot more confidence in choosing that offer because their risk is near zero. As long as their mortgage is good to go, we're good to go. So there's a lot of power here in these appraisal waivers. For consideration, though, there's some caveats. if there's anything that comes up on that property data report, you could need to have an appraisal actually performed. If there's any change to the price, so if a renegotiation happens for some reason and we get an appraisal waiver at one price point and then the price point changes, that could remove the eligibility, and that will be on a case-by-case basis. By and large, again, this is for Freddie Mac conventional loans, and this is amazing. This is coming into effect as of February 24th, 2025. So moving forward, when I'm assisting clients and when other mortgage professionals are doing so, and they're uploading everything into Freddie Mac's automated underwriting system, we could be seeing more of these appraisal waivers. So keep an eye out for that. For our fun fact segment today, we're going to talk actually about real estate. The number two largest amount of real estate owned by a private company or person is Walt Disney. Yes, Walt Disney Company owns the second largest amount of privately owned real estate in the country, and they are only second to the Catholic Church. Interesting. There's a really fun fact, and for those that are interested in deep diving on this, I encourage you to check out the history of Disney World in Florida and Walt Disney's strategy in his obtaining of the real estate in that area and in the market surrounding where Disney World is right now. It's really interesting. I'll bury the lead there, let you go check that out. For our Did You Know segment today, we are going to talk about home equity loans versus HELOCs. So we spent the past 2 weeks talking about home equity loans, and then we talked about HELOCs last week. So today we're going to do a comparative analysis of both. So again, we're going to do a quick refresher because it's been 2 weeks. So home equity loans, lump sum at closing. You get all the money at closing. You have a fixed rate for the life of the loan. The life of the loan meaning your term, and that term could be anywhere from 5 years all the way out to 30 years. Your monthly payments are fixed and what we call fully amortizing. That means every payment you make has a portion that's going toward interest and a portion that's going toward principal. And then by the end of that loan term, the mortgage is fully paid off. The borrowing limit on this varies customarily. We're in the 80% to 85% of current home value range, but I can speak to a few of the relationships we have here at Rate. Some of our investors will go up further than that. The only caution is the higher up you go in that loan to value, the more access of equity that you explore, the higher your interest rate is going to be. So please do bear that in mind. This is best for one-time expenses, where you need a lump sum for debt consolidation or to do property improvements, things like that. And homeowners normally prefer this because you have a consistency of payments and predictability in your payments. Home equity lines of credit, for the quick refresher, is a revolving line of credit. Think like a credit card. It just happens to be secured. Your credit card is what we call unsecured debt because it's not tied to any asset. But a home equity line of credit is tied to the asset of your property, and it operates similar to a credit card. The interest rates are variable on these, although there are some programs available for HELOCs that are fixed. Again, speaking to what we offer at Rate, we offer a proprietary HELOC that is fixed. The payment structure is typically interest only. So a traditional HELOC means that you're only paying interest on the money that you've borrowed from your line of credit. And if you pay that down, your interest payment reduces because you're only paying interest on what you've borrowed. Principal and interest payments normally kick in after your draw period. And the draw period customarily is the first 10 years of the HELOC. So in the first 10 years of the HELOC, it's interest only. You draw from it and repay freely with your minimum monthly payment that you're obligated on is just interest. Once you reach the expiration of that 10-year draw period, or if it's shorter based on your lender, then you go into repayment. And then the repayment turns into a 5, 10, 15, 20 year, sometimes even 30-year mortgage, and you will have a fully amortizing payment like your home equity. You can kind of think of it like if you know you need your money right now for something, you take out a home equity loan. If you're like, I may need money, we're kicking around the idea of some home improvement, but we're not sure about it yet, then a HELOC's the right choice. and you get that set up, because essentially the HELOC will turn into what that home equity mortgage looks like after you've settled up what you're going to need, you've taken out what you need, and you go into the repayment phase. It's also really good for ongoing expenses. So when you have a HELOC, if you know that, every year we're going to have this bigger expense that I like to have spread out, it's a great tool for managing that. And it's best for homeowners that are comfortable with varying payments. We talk about the interest rates on a weekly basis. They change on a weekly basis. Because HELOCs have adjustable rates, it means your interest payment could adjust month over month. So that's something to be considerate of. If you're comfortable with it, then you're good to go. So now we're just going to do a side-by-side comparison, one versus the other. So we're going to compare home equity loans, those are the fixed rate, fully amortizing, to HELOCs. We're going to start off with the interest rates. Starting off with interest rates, and you know what? I'm going to throw up a graphic over here. So for those who are not just listening, but watching on YouTube, I got a graphic up for you. So starting off, home equity loans. Interest rates. Home equity loans, fixed rate, fully amortizing. HELOCs, adjustable for the draw period, and then goes, and normally it fluctuates with the Wall Street Journal prime rate. That's the most commonly used market index. When you have an adjustable mortgage in any sense, that adjustable rate mortgage is tied to a market indicator. The market indicator most commonly used for HELOCs, Wall Street Journal prime. Next up, payment type. Home equity loan. Fixed monthly payments, fully amortizing, principal and interest in every payment. HELOCs, interest only for the draw period, customarily 10 years, and then it's variable later when you go into repayment. You could still have a variable rate even when you have the fully amortizing 5, 10, 15, 20-year loan when you're in repayment phase. Access to funds. Home equity loan, lump sum at closing, cash in the bank for you to manage, and you have your monthly payment. Home equity lines of credit, HELOCs, flexibility. You could take out as much at closing as you like, or leave some line open and available, like on a credit card, and then draw from it when you need the funds. Best for. I like this category. What are these best for? Home equity loans. We touched upon this before, but to recap, home equity loans are perfect for one-time expenses. If it's a one-time renovation you're doing on your property, if it's debt consolidation to consolidate the credit card debt that may have run up over the past couple years, great option, fixed rate, fixed monthly payments. HELOCs, ongoing expenses. If you have future funding needs and you don't have an immediate need, setting up a HELOC works great. The caveat here that I'll share for HELOCs. I said this last week, but I want to highlight again. HELOCs are great and best suited to be obtained when you don't need them. So when you don't need the HELOC, that's the best time to get it. So remember that. Get the HELOC, have it established, especially if you have anticipation in the next 6 to 12 months that you're going to have a cash need. Great thing to do. There's no pressure, no timeline, no deadline on you. Now the risks. So on home equity loans, there's not a lot of risk compared to HELOCs. You have a fixed rate. You have a fixed monthly payment. That automatically, categorically, side by side, creates way less risk for you. The risk that is inherent there, though, is if you overextend your credit again after paying off credit cards, if you used it for debt consolidation purposes, and then you start having issues paying back that mortgage. When that mortgage goes into foreclosure or goes into default, it could create foreclosure, and that's a problem. So that is the risk there. So if you're going to use it for debt consolidation purposes, change your financial plan. Whatever you were doing before, don't do the same thing now. If you're tapping into your home equity to consolidate your debt, a behavioral change is required as well. Just some fun, friendly advice. HELOCs, a little bit more risky. There's adjustable payments and adjustable rates involved. So it is a riskier one that comes with the benefit of more flexibility. But bear that in mind. If you can't tolerate the risk of interest rates moving and that monthly payment possibly going up, going down is nice, but the risk side is if it goes up, bear that in mind. And you can possibly mitigate some of that risk by prudently drawing and repaying. But side by side, I want to at least highlight the risks of both of those. lastly, I want to talk tax deductibility. I'm not an accountant, so I would defer you to your tax professional. But if you are going to use the funds from a home equity mortgage or a HELOC for home improvement purposes, you may have a tax deductibility aspect available for your interest rate. Talk to your accountant about that. That could be something that's beneficial to you as well. So in summary, I think we did a good job of covering our bases here for HELOCs versus home equity mortgages. Lump sum versus line of credit, draw from, treat it like a credit card. In both of these cases, I want to highlight this. If you're going to use this for debt consolidation in either case, make sure you're talking to a financial advisor or financial professional to rein in your financial plan, because I see it happen all too often where these loans get leveraged and it provides relief, and then a year or two later, oh, I need to do another one, or I need to tap into more home equity. And that's not good. And I just want to be looking out for you here. Make sure that if you're going to pursue this type of financing, that a game plan is implemented to make spending habit behavioral changes and budgeting changes so that you don't risk falling behind possibly in the future on this new mortgage, or falling behind on your other credit cards if those debts start to run up again. That is it for me today. I hope you found this information helpful and useful. If there's any feedback that you have, anything you'd like me to dive more deeply into, or if you have any questions, concerns, comments about the show, please reach out to me via email at peter.d'angelo@rate.com. You can also find me on socials. I am on Instagram at peter.d'angelo.rate. Feel free to like, follow, send me a DM. Let me know if you've got anything you'd like me to cover on the show. I will be looking forward to a new episode next week with the latest and greatest on mortgage rates. We should also have some existing home sales data for January, which I'm very interested to see. So yeah, it's February 20th right now. We're going to keep an eye out for that. In the meantime, I hope you all have a wonderful weekend ahead. Stay warm and take good care.